This presentation is going to look at how we can try to control inflation using the interest rate. Although we will see that when we say the interest rate, we actually mean one of several interest rates in the economy. Anyway, let's have a look at what we mean by the interest rate. The interest rate is the single most important variable that we can control in the macroeconomy. So what is the interest rate? Well, one way to think about the interest rate is that it's the cost of borrowing. For example, if you borrow £1,000 from a bank for 5 years at an interest rate of 7%, then you may have to pay the £1,000 back at the end of 5 years. But each year you will also have to pay £70 to the bank, because you have promised to pay interest at a rate of 7%. So as well as the £1,000, you will end up making 5 payments of £70, and they represent the interest payments. So in this sense, the cost of borrowing the £1,000 is the 5 payments of £70 that you have to make as interest. The interest rate can also be seen as the reward for saving money. For example, if you deposit £1,000 in a bank at an interest rate of 4% for 1 year, the bank will reward you for doing that. And at the end of 1 year, you will have more than your original £1,000 in the bank. In fact, if the interest rate is 4%, you will have £1,040. So in this way, the interest rate can be seen as a reward for saving. But notice that we have mentioned 2 different interest rates. The one for borrowing, we said, was 7%, whereas the one for saving was only 4%. Now, this is typically what banks do. They charge a higher interest rate to people who borrow compared to what they pay the people who save. So this shows that there is more than one interest rate in the economy. There is an interest rate for borrowing, there is an interest rate for saving, and usually the one for borrowing is higher than the one for saving. But the actual interest rate also depends on how much you borrow or save. So if you borrow or save £1,000, the interest rates that you get or have to pay will be different than if you borrow or save £50,000. Also, the interest rate depends on how long you borrow or save for. So if you borrow £1,000 for 5 years, the interest rate may be 7%. But if you borrow £1,000 for 15 years, you may have to pay a higher interest rate. Similarly, if you save your money for a year, you might be paid 4% a year. But if you agree to keep your money in a bank for 5 years, the bank might offer you a slightly higher interest rate for saving the money for a longer period of time. For example, 4.5%. In any case, what we learn is that there are many interest rates in the economy. However, there is one particular interest rate that is of great importance to us. And to understand that one, we have to understand what we mean by the central bank. Every economy has a central bank. This is not a bank that deals with customers in the way that commercial banks do. For example, Barclays Bank, which has both business customers and individual households who are customers. The central bank has no customers as such, because the job of the central bank is different to the job of other banks. The central bank in the UK is called the Bank of England, but every major economy has a central bank. So what is the job of the central bank? Well, the primary mission or primary job of the central bank is to control inflation. That is the number one purpose of any central bank. And the central bank sometimes, from time to time, in the normal course of events, has to lend money to commercial banks. So every month, or every few months, or every few weeks, commercial banks such as Barclays Bank, HSBC, NatWest are in a situation where they have to borrow money from the central bank. Now, exactly why this happens is not really important. The fact is that it does happen. commercial banks regularly have to borrow money from the central bank for short periods of time. Now, when the central bank lends money to commercial banks, it charges an interest rate, and this is the most important interest rate in the whole economy. This is the interest rate charged by the central bank when it lends money to commercial banks like Barclays, HSBC, etc. Now, this interest rate has a special name. It's called the bank rate. And the bank rate can be increased or decreased according to what the central bank wants to do. So the decision on the bank rate is purely taken by the central bank, independently. If, for example, the central bank decides to increase the bank rate, if it decides to increase this bank rate, then this means that borrowing has suddenly become more expensive for commercial banks. When they borrow money from the central bank, they are having to pay a higher interest rate. Now, their reaction will probably be to increase the lending rate that they charge their customers when customers want to borrow money from them. And this is how interest rates have an effect on the economy. If the central bank increases the bank rate, commercial banks will increase their lending rates. At least that's what will happen most of the time. And when lending rates go up, then households and firms find it more expensive to borrow money. So if a household wants to borrow money, for example, to buy a car, or even a mortgage to buy a house, they will find it more expensive. And if they're borrowing for small items, this will also be more expensive. Firms will find it more expensive to borrow money for investment. And if borrowing is more expensive, then borrowing will decrease. The amount of borrowing done by households and firms will go down. And this will mean that consumer spending and investment spending in the economy will also go down. So the knock-on effect is that when the bank rate is increased, lending rates go up. And when lending rates go up, borrowing goes down, and that means certain types of spending in the economy, such as consumer spending and investment spending by firms, also go down. Now we know that aggregate demand is the sum of consumer spending, investment spending, government spending, and foreigner spending. So anything that causes consumer spending and investment spending to fall will obviously affect aggregate demand in a downward direction. So if consumer spending and investment spending decline, then aggregate demand will also decline. And this is the weapon that the central bank uses against demand pull inflation. Demand pull inflation, remember, is when aggregate demand is greater than aggregate supply. So in order to fight demand pull inflation, the central bank has to find a way of reducing aggregate demand. And the way it does this is by increasing the bank rate, which leads to a higher cost of borrowing for both households and firms from commercial banks. And this leads to lower consumption and investment spending, and therefore lower aggregate demand. Actually, this is an example of what we call contractionary monetary policy. Contractionary monetary policy. Contractionary, or rather monetary policy, is the control of interest rates and the control of the money supply. So anything that has to do with the control of interest rates or the control of the money supply is called monetary policy. And contractionary means anything which is designed to reduce aggregate demand. So when the central bank increases the bank rate, this is an example of contractionary monetary policy. In fact, increasing the bank rate is just about the only weapon or only response the central bank can make to inflation. It happens to work very well when the inflation is demand-pull inflation, but even if the inflation is due to cost-push factors, in other words, factors of production becoming more expensive, the only thing that the central bank can really do is increase the bank rate, which isn't going to work very well against cost-push inflation, because the inflation here is not being caused by aggregate demand being too high, but it's still the only thing the central bank, can really do. So we have to bear this in mind. So in summary, monetary policy can be used to control inflation via the interest rate. So by using the interest rate, in other words the bank rate, we can try to control inflation using monetary policy. And this type of policy, is best used against demand pull inflation. But really, it's the only thing that the central bank can do against any type of inflation.